Hey traders, Jason from Levitt Brothers. So in this video I'm going to talk about the Fed cutting rates. They cut 50 basis points yesterday, and the question is now what? Like, what is the market likely to do? There are different schools of thought. I'm going to go over a couple different schools, and then we'll wrap it up with what is most likely going to happen over the next year, or I should say in a year from now. All right, so first, you've probably seen this chart somewhere out there. It was published in 2022, so it's not completely up to date, but that doesn't matter because the Fed hasn't done a rate cutting cycle since then. So anyways, it points out 6 times since 1969 that the Fed cut rates, and it shows the declines that followed. Okay, so when COVID broke out, the Fed cut rates and the market dropped 35%. Financial crisis down 58%. Dot-com bubble 51%. Early 80s, 70s, late 60s, and you can see what happened. Okay, so the market, these are times where like the market did well and then it rolled over, it topped, it started going down, and the Fed rapidly started cutting rates to try and dampen the downside momentum, and the market ended up falling anyways. And the argument is that the Fed just started cutting rates. They cut 50 basis points yesterday. And so with the change in tone, with the quote-unquote Fed pivot, the market is likely to follow one of these paths, and we're going to have a bear market. So that is one argument. Then Ryan Dietrich of Carson posted this just a day or so ago. And these are, and I know that's hard to read, so I'll go through it. But he talks about the S&P performance after the Fed cuts rates when the S&P is within 2% of its all-time high. Okay, so the S&P is in blue. It goes back to 1980 over here. And then each of these green dots over here are times when the Fed cut rates and the market was within 2% of its high. I don't think this might not be readable, so I'll just go through it. This is your 1-month return. The market is only up 45% of the time, and the return is negative. So not a great 1-month return. The 3 and 6 month returns are better. The market is up 75% of the time, and the gains are, small positive, like 2.1% here and 3.8% here. So that's actually it's like below average. Okay, the market is up, but not up that much. And then the 12-month return is the market is up 100% of the time. Okay, so when the Fed cuts rates and the S&P is within 2% of its high, the market is up 100% of the time 12 months later, and the average return is 13.9%. The median return is just under 10%. That's a big difference. So the question is, which one of these is correct? Is it this one? Or is it this one? Okay, in my opinion, both of them are extremely misleading to the point of just almost being dishonest. Okay, this one obviously cherry picks 6 times where the market went down, but the Fed cut rates more than 6 times. Okay, there have been more than 6 rate cutting cycles. This dude, whoever put this together, this down here says November 2022, L8 Wave International. Whoever put this together cherry-picked 6 times that the market was in trouble anyways and the Fed was cutting rates. So I don't think you can just blindly expect the market to fall apart just because of these 6 instances. Okay, but likewise, I don't think you could just assume that a year from now the market is going to be up, although even though that's what the data says, because Dietrich has this extremely restrictive, within 2% of all times high. Well, why not 3%? Why not 4%? Why not 5%? Okay, because after the dot-com bubble, right here's the dot-com bubble, after the market topped and fell a little bit, then the Fed started cutting rates over here. The market was already more than 2% off its high, so therefore this data didn't show up in these stats over here. Okay, financial crisis, same thing. Market top starts falling. It's more than 2% off the high. The Fed starts cutting rates, but because it's more than 2% off the high, it's not included in the data. Like both of these were huge drawdowns on all monthly time periods. And it's not included in the data because Dietrich has this extremely restrictive 2% criteria. So both of them to me are like misleading at best and just flat out like cherry picking specific data just to kind of make a point that they want to make. So the answer is what actually is going to happen. This is probably what I think is the best chart out there. I just saw this the other day. Source is Goldman Sachs. It was as of September 12th, so a week ago. What this shows is the vertical line here is the first rate cut. Okay, the blue line shows the path that the market has followed when there has been no recession. So you can see the blue line over here. Then we have a rate cut where all three of these lines come together. And then if there's no recession, the market tends to do very well, and the average gain is 10 to 17%. The gray line, which you can see over here, and then we come over, and then everything meets in the middle here. The gray line is when there is a recession. You can see Fed cuts rates, market drops, average down is 15 to 20%. Okay, so to me, and then the green line is what we currently are. So we don't get anything from the green line other than the fact that we've had a much bigger pre-cut move here. So to me, this is the answer. If there is a recession in the next 12 months, the market is likely to do this. If there's no recession in the next 12 months, the market is likely to do this. Okay? Now, but keep something in mind, is that a recession technically is like 2 consecutive quarters of negative GDP. Okay? 2 consecutive quarters, that's 6 months, which means by definition, you don't even find out that there's a recession until we're already 6 months into the recession. So you can't wait till a recession is declared and then decide or realize like, okay, the market's probably going to go down. We're already 6 months into it. Okay? So follow the charts, follow the market. The market is smarter than every economist out there. The market is smarter than every single macro dude out there, no matter how fancy they talk and how smart they sound. The reality is the market is smarter than all of those guys. So follow the market. If the market struggles, then it's probably suggesting we're going to, we have a high likelihood of a recession coming up. If the market continues to go up, then we're not getting a recession, and as you can see here, the market is likely to do very well. To me, this is the best chart. This is the one that tells us what's likely to happen. Of course, we don't know because we don't know if we have a recession, but this is the one to key on. And what it suggests, before I finish up here, is that the rate cuts probably don't matter. Okay, the Fed could cut a lot. Maybe they can hold. It doesn't matter. The only thing that really matters is the economy. If we have a recession, market follows one path. If we don't have a recession, the market follows another path. Okay, that is the most important thing, not the rate cuts themselves. All right, we'll see you next time.